All right. Here we go. Happy Black Friday evening. Let's take a look at the work that we got to get to right away. So what do we got first? We got a bunch of different docs to go through here, so I'd just like to get started and start jumping through them so we can be efficient on this good old Friday here. Hope you're enjoying your Black Friday evening. So what do we have here? Quarterly Consumer Chart Book, one-stop shop for monitoring the U.S. consumer in Q4 here from Morgan Stanley, monitoring the U.S. consumer. So let's take a look here. I did notice a Bloomberg piece. Bloomberg suggested it was Bed Bath & Beyond, and there were a few others. Yeah, here it was. It was like Gen Z stores. Bed Bath & Beyond, Aloe, Brandy, Melville. We're having apparently good sales, as well as like Kendra Scott and Idic Ted. I don't know what the heck this is, what this company is, but these were some that Bloomberg was reporting as having some pretty good activity. They called them Gen Z and teen brands seem to be winning. That was interesting. But anyway, this here from Morgan Stanley discusses a few different things here. So first they say, we published our economics outlook for 2026. We expect softer consumption growth in the near term and slower job growth and still elevated inflation. So not yet great, might still be early on consumer discretion recovery based on, well, I mean, frankly, still anemic job growth, and then this expectation that the consumer is going to be totally fine. Okay. Throughout 2026, though, we expect a sequential improvement, so that means quarter over quarter. We expect peak effects from tariffs and immigration will be behind us from tariffs and immigration, so that's good. Monetary policy and fiscal policy should be supportive. Okay, cool. So that could be nice. Fiscal boost to consumption will be the most apparent in Q1 through higher tax refunds. We expect to quantify our expectations around the effects of the fiscal bill on income and spending, as well as how much to expect. But we expect the effects on spending to be more smooth throughout the year. I mean, I would make the argument that really tax refunds will start showing up in March and April, obviously. So I'd argue that, by the, I mean, it's probably already too late, but by the May employment numbers, we should already know if we're confirming a soft landing or not. Everything's sort of been delayed by, the tariff pull forward and all the nonsense around tariffs in 2025. So as usual, things always take a little longer than can sometimes be expected. But I mean, by then it'll almost be too late. I feel like really what you really have to get through is going to be the first quarter of employment data. Typically if we have a weak Q4 and January looks like it's going to be weak, I would guess probably February would be my guess on peak layoffs. And if that's benign, plus obviously Jan and March, we're probably sticking a soft landing if we get benign numbers there. So we'll see. They do say that they expect a slower real income growth in the second half to weigh on spending in the near term, resulting in a somewhat weaker end to 2025 and start. Yeah, so here's your weakness, right? Your Q4 and Q1 weakness is what they're arguing. Okay, cool. So let's see how they break this down. So that was sort of a little intro that they give here. Near-term slowdown followed by an improvement. Here you can kind of see where they expect that spending to go. That's always interesting to see. So negative on goods here. This is Morgan Stanley actually going negative on goods. Still positive on services, though quite a little hole over here. And then you can really see it takes until Q3, Q4 where you get the meaningful recovery in spending, and then they sort of gradually, line everything or smooth everything out. So that's interesting. Yeah, Q3 over here being somewhat weak. Take a peek at that here as well in 2025. Will the K-shaped economy continue? I don't see why not. Top 20% of households hold 71% of the nation's net worth. We expect high-income households to continue being supportive of the positive wealth effects next year. Near-term, low-middle-income consumers will still face headwinds, however, as inflation comes down. And a fiscal bill boosts incomes. Easier monetary policy will provide some support. Right, so basically, lower taxes and lower rates on credit cards and cars should be supportive, as well as lower inflation. But that'll probably take until the end of next year for it to really hit the broader side of the consumer. Yeah, welcome on in here for somebody here says 22 million on calls for Microsoft 1225. Wow, that's pretty wild. If you know, that's sort of the broad market call expiration there on the 12th. I think what you're going to find is the problem is the Federal Reserve, unfortunately, is going to have to be a little bit hawkish December 10th. Otherwise, they're going to send this bizarre signal to markets that we don't care about inflation, you know, and we're just going to cut even though there's no inflation, or even though there's a risk to inflation, rather. So I do think that is why we're going to have a hawkish Powell. So I expect hawkish Powell on Dece 10, which to me suggests, you know, you want to be out of your bullish short-term positions by December 9th. Consumer consumption expected to grow incrementally and sequentially. Labor growth. Let's see what they have over here. Due to the government shutdown, payroll data, we have a September, blah, 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 increase in labor force participation. We expect labor demand and labor supply growth to remain slow. Unemployment rate to rise to 4.7% by the middle of 2026. That's not a doomsday scenario at all. Not that bad. Like, that's totally manageable. So I don't see that as a big problem. This is a bigger problem here. Beveridge curve is an empirical regularity. Okay. It shows a nice current chart of the Beveridge curve. We haven't seen one of these in a while. A good current chart over here. This abnormalness right here. So pre-COVID trend in blue. You got this yellowish trend after COVID, and we're this sort of like bizarre vertical level of the Beveridge curve, whatever you want to call it. Now, you could argue that the market just, that this is like a new normal, but arguing this new normal basically assumes that, we won't see a normalization in excess retirees. So we could say that new normal argument really assumes markets that stay afloat and frothy, preventing excess retirees from coming back to work, right? So this will work until it doesn't, and then likely it'll expand the way it always has in history. Labor force participation rebounded somewhat. Let's see here. We expect the participation rate to decline again in 2026 and 2027. We'll see about that. But if it does, that would actually be your bullish direction, all right? This would be very bullish, as it would offset potential layoffs if this does occur. So they argue that this recent increase in participation was amongst younger individuals, and unfortunately, they think that more restrictive policy has led to a chilling effect on labor force participation, led by slower immigration and demographics. Okay, and then they forecast basically a normalization. So they're forecasting a normalization. Okay, that's fine. We don't have to say much there. Okay, interesting from Morgan Stanley. Labor flows deteriorated somewhat further. Wage growth is moderated. This reduces wage pressures, which is actually good for keeping inflation down, but it just sucks for humans, right? Let's see. Okay. What else here? Sounds like your mic is too high. Scratchy audio, really? Somebody says, I hear him fine. Here, you want to get rid of the keyboard? There. How's that? Maybe that's better. All right, income growth has slowed but rebounded somewhat in September. Okay, fine. Consumption and sentiment. We know sentiment is certainly declining. This has been sort of a feature of this market, though, for a while, that we've got this declining trend here. So nothing pretty wild there. Somebody in the chat says, I feel like Bitcoin is on sale at 90,000. Okay. Oh, is there a weird echo now? Really? Oh. It's fine now, it's bad. I guess I screwed it up. Oh no, that's unfortunate. That's alright, I went back. Interesting. I wonder why that would occur. So audio mixer, yeah, that's quite bizarre. I'll have to look into that. Really? Doubled on that, huh? Alright. Okay, well, we'll just stay here then. So, let's see here. Okay, that's good. Growth in real services spending, fine. Savings rate declining slightly. I mean, this bobs around. This seems pretty well normalized. I wouldn't say this is anything abnormal. Savings rate, credit balances, liquid assets continue to grow. Nothing too exciting in the rest of this. I think really their argument here actually paints a bullish case where, you know, you could actually see participation decrease again, and that would be quite bullish. Okay, cool. So, charts that caught my eye. Let's see what we have here. So, guiding principle, investment process, blah, 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 blah. AI convergence. Ooh, the convergence of AI. We believe that stocks exposure to thematics alone, price sensitivity regression, blah, 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 tech diffusion, AI plays, 5 different cohorts, blah, blah, blah. Okay. Near-term weakness offers opportunity to add long exposure. We remain highly convinced in our bullish S&P price target of 7,800. So revisions breadth for the NASDAQ rose, with small cap showing the greatest upside inflection. So Morgan's pretty bullish here. Soft lines stocks. What is this? Our house call is that U.S. equity market is transitioning to an early cycle environment. Wow. We have double upgraded consumer discretionary goods to overweight. Wow. Soft line retail. So what, like clothing or what? Oh, Gap, Macy's, Urban Outfitters. Wow. Interesting. Who's winning the AI race in the consumer sector? Let's see here. Implementation, blah, 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 blah. Future of energy. Okay. Outlook. What is this? Macro and demand looks healthy, but supply should rise. Of CapEx or what? Or of chips? Financing needs for AI-related CapEx, an outsized driver of supply. Notably, we believe issuers funding AI CapEx might be relatively price insensitive about the cost of debt financing. We think this is showing up in the form of new issuance concession, higher yields on a new bond than a comparable bond already trading. Right. So basically, it's becoming a little bit more expensive to you know, what's it called? Get your financing. Somebody in the chat writes malls were empty today. Yikes. All right. Agentic shoppers are coming. Deep fulfillment moats are going to be Walmart, Amazon, and Wayfair looking best positioned, while players with high take rates or that are search dependent. This could also be Pins, by the way. Wouldn't be surprised if Pins is pretty search dependent there. So I'll take a peek at that. To disrupt or not disrupt. Yeah, I mean, one thing that's been so interesting for us is so many people have joined the lifetime access for the Reinvest AI that HouseTech is doing. And I was just going through our latest, it's called a test flight on Apple for the app, and it's just incredible. I mean, I'm looking here at deals that I just wouldn't have had time to look at. I'm able to look in whatever zip code I want in the country and just rate deals and have them provided to me by like the order of priority. And it's not to say it's going to find every deal, but like we are on the track to basically net worth sniping real estate deals across the entire country and basically democratizing what flippers do for every human in America who wants to buy a house. I mean, this is so cool. So every time I think of like the AI bubble, or people talking about the AI bubble, what I do is I go in and I put a new zip code in, and I'm like, okay, I'll check Florida, I'll check Weston Hills, I'll check Davie, I'll check Plantation, I'll check San Diego, whatever. I put a new zip code in, or a new city in America, like I'll go look at Boston or Manhattan or whatever. And then I look at this, and then I'm just like blown away that I could click basically any city and be like, oh, those are the deals I should be prioritizing my time looking at right now. And it really consolidates the time that it takes to look at all these real estate listings massively. So it's actually really incredible what we've built so far, and big shout out to the team so far. I'm always of the mindset where I'm just like, I think sometimes I need to take a little break and just remember like how far we've already come with our AI, and just like make sure I really thank everybody for their great work, because sometimes I get so excited about like, all right, good, that's done. Let's focus on what's next. Like, let's get the next feature, the next feature, the next feature. And it's easy to kind of forget about how far it's already come. So it's really cool. And so everybody who's in the Reinvest AI membership will get their access to that in December. So that's very exciting. But yeah, I mean, every time I hear this talk about AI bubble, now I put it into perspective of, being a company that's selling an AI service. And I look and I say, wow, well, I mean, we are literally creating value, in my opinion, for any single person who wants to build their net worth through an app, basically, across the entire United States. And like, the value we create relative to what we cost, I think there's an exponential difference. So to me, every time I look at talk about AI bubble or infrastructure or spending or whatever, again, I just look at like the money that we've invested into AI, and then I mean we've already made more money on our AI product than we have spent on artificial intelligence, right? So like we are already at HouseHack ROI positive, like significantly ROI positive on our investments into like Blackwell chips and hardware. So I can't help but think like, well, if we're feeling like that, I'm sure there are a lot of companies, whether it's like the Palantir or, I'll throw us in the list, why not? HouseHack, Reinvest. I can't help but think companies that are throwing money into this, whether it's Meta or Google or whatever, like, oh no, yeah, we're making an ROI on this. I think the company that's probably most pissed are the sentiment replacements, and those might be like the Duolingo or the Adobes, who are like, do we still need these products? I guess time will tell. But like those seem to be selling for rapid discounts right now, which is kind of interesting for publicly traded. But yeah, anyway. So AI data center beneficiaries, which group will benefit the most from this data center expansion? And so you've got hyperscalers here. This is sort of the bet, right, over the next 12 months. I actually think that's wrong, but okay. And this is Europe's, what is this? Europe's biggest TMT growth opportunity, Gen AI bubble, 55%. Yeah, I mean, which group will benefit the most? I mean, I guess if you had to choose from these, fine. But to me, it seems like software should be a group over here, but I guess they're specifically asking about data center, so that's fine. Somewhat interesting. See, like here in Europe, they mention AI software. I think that's more correct. Like that to me, and that's only a 40% shot here. Other people going into data and digital media or content or whatever. But really, it's SaaS. What AI does is AI makes SaaS more accessible, for not only new startups and new ideas, but also broad adoption. Let's write that down. AI makes it easier for startups to compete with big software dogs, and who wins in that, right? Who wins? Software legacy companies lose margins, but startups and the consumer win, right? That's what I think is very interesting. So very interesting. Somebody here writes Kevin B. Putin in the real work. That's awesome. Can't wait for me, Kevin, app for desktop. So yeah, well, one of these days. Hey Kevin, I watched your video and I'm trying to understand that once you guys IPO, anyone who bought the Reinvest app will get a small No, like, you have to understand, I mean, that doesn't even make sense. Like, if you go to the Reinvest website, it should be pretty obvious. If you want, like, ownership in the business, you invest in the business. If you want to use the product, you buy the product, right? So, like, there's a Reinvest AI product. And then there's investing in the business. Those are very different things. And that's all at househack.com. But anyway, all right, let's keep going here. Which is also separate then from the Meet Kevin membership at meetkevin.com. That's like Alpha Report and the new course and everything. That's all included. So what do we got over here? Then you've got, let's see, official data releases are 2 months behind schedule. In our current environment, data dependence has been replaced by forward guidance. This feels like an eternity. Yeah, any cap on max investment amount? Well, we've never been asked that before. I'll put it that way. But I mean, I personally have invested $5 million in one transaction, so you know, we know that works. But anyway, however, even with the lack of official data to confirm, workings of economic trends have not changed. Recoveries happen slowly, but deteriorations can happen suddenly. Right, and that's just what you want to avoid. You're still somewhat sensitive to you know, some form of a downside shock that we want to avoid, of course. Let's see here. Weak economy outside of AI spending. Okay. And we see a risk of a more rapid decline in the months ahead as firms stop hoarding. Right. This is like the test moment, right? The next few months are the test. The next, call it 4 months, are the test. If firms stop hoarding because holiday sales were slow, then we have poopsie doopsies, right? So that's not good. So let's see here. Market thoughts. Important crossroads on the combination of momentum fading, solid returns year. Yeah, I mean, that is also true. Like, we've had a very good a good run so far. So, you know, how much further you know, are we going to go? Okay, so then if subsequent data release or Fed surprise market may have an uncharacteristic jump in vol, we argue to remain disciplined and defensive while seeking liquid assets. We believe that anti-seasonals, along with the, let's see here, pulled forward, along with the risk of the Fed does a hawkish cut or worse skip, could accelerate downturns. I mean, I think we're going to get a hawkish cut, and I do think that would accelerate downturns, because if the Fed guides a pause after DEES, then markets may be sad that we're kind of staying at these higher levels, right? Which is unfortunate. Okay. Let's see here. With key months of data unavailable by... Oh, what's all this yapping about audio? Nothing's changed about my audio as far as I can tell. Audio 1. Oh well. All right. So, okay, with key months of data unavailable by the next Fed meeting, it's going to be a close call, but we think the Fed will cut. Sure. Overall, we do not believe the Fed will ignore the alternative data, which has been pointing to further labor market weakness. We argue that a hold sometime in Q1 makes more sense. Year-end signs of liquidity constraints at the bank. Well, the repo numbers weren't that great either. Okay, stablecoin topic. Macro musings, official data are 2 months behind schedule. Thank you for suggesting the audio is actually okay. Appreciate that. Somebody says, would you recommend paying off debt? I do almost every video, I feel like, say that. It's like, please pay off debt. Don't get caught with your pants down. It's the number one thing that destroys people. You know, everybody gets lulled into the sense of security that everything only goes up. And then all it takes is one bad week and the market's down 30%. And you're like, yo, what the hell? I didn't even have a chance. And then you get margin called, and you know, it's the feeling of despair can set in so quickly. You know, a lot of wealth could really be destroyed. So, you know, as long as you don't have debt, it doesn't matter. If you don't have debt, who cares? Like, you know, in the Meet Kevin Alpha group, Alpha membership, the top 10 stocks that I'm buying over the next 10 years, I don't care if they all go down 90%. It literally changes my life zero, because there's no debt, and I'm not relying on them. And the money I put in them, I don't need to touch, ever. They could all lose 100% and make no difference at all. And I think that's if you could say that about your portfolio, perfect, great. But anytime you have pressures or stresses that suggest you might need to sell at some point, you know, you'll find your reason to sell, and it's sometimes unfortunate. But that's how mistakes are made. In our current environment where data dependence has replaced forward guidance, feels like an attorney, lack of okay. I think this is just really getting into detail a little bit. Revelio Labs and ADP are some of the leading data providers. So we're skeptical about the private non-farm payroll data, saying 97K were added in September. Let's see here. Non-farm payrolls data has been consistently revised negative. Announced layoffs also reached a post-pandemic high, highlighting how truly fragile the labor market is right now. Right, like, we did get this cool September jobs report, but, like, what if that just gets smashed way down, you know, with revisions later? I mean, I guess that's always a risk factor. And kind of wild that we're not going to get the October and November data until after the Fed meeting, which isn't great. But, you know, what are you going to do? Adding insult to injury, the government shutdown likely had a negative impact on Q4 GDP, while the government investment portion of GDP will surely be affected. A big chunk of economic loss could come from a drop in spending. Evidence shows considerable slowdown in October. That's having to do with the government shutdown here. Yeah. Very good. Okay. So, let's see. All of these headwinds. Chicago Fed's model implied probability of a possibility that shows a reasonable possibility that unemployment will hit 4.6% in November, above the projection. Okay. Let's see here. So they'll cut again 25. That's fine. This is just a little bit more data that they have. Whimper with a bank, or just the Fed call. Okay. Stable. Okay. All right. So that's theirs. That's their piece. Macro strategy from MUFG. Let's take a look at another one. Here's UBS. If AI increases productivity from 2028 half as much as TMT was temporarily perceived to have done, then we can easily justify technology and media 7,000 on the S&P 500. Yet we think Gen AI, the steam engine of the mind, will increase productivity more than it did in the late 90s. Okay. We also have now 7 preconditions of a bubble that were not yet in historically. Wait, what? We also have all 7 preconditions for a bubble that were not yet in historically. The peak PE bubble has been 45 to 72 on a 12-month trailing versus Mag 6 today, 33. Showing performance patterns today are most similar to March of 98. We are far removed from any major catalyst that mark a bubble peak. Okay. So we have the preconditions for a bubble that has not occurred yet. Got it. So this is more like March of 98. So in other words, the true euphoria could still be ahead. That Thank you for all your contributions to all of us here. You're an inspiration, blessing. May God bless you and your family. Your courses gave me a direction. Oh, that's awesome. Well, super grateful to hear that. Thank you. Happy things are good for you. Let's see here. U.S. forward-looking indicators point to a further decline in jobs. Well, yeah, I mean, that's the big risk factor right now. Who was this from? Weak consumer expectations and falling service and manufacturing PMI employment indices signal a drop in payrolls coming. Yeah. Worth adding that here. PMIs add to this. So weak PMIs suggest worse labor reports coming. So it's really like buckle up kind of phase. But this is also very interesting because here they're basically saying, hey, we're not even at the height of the tech bubble yet. Only thing that would derail this would be labor. A labor recession could add cold water to an otherwise good bubble. Right? We think there's more justification for a bubble to form. Okay. Yeah, I don't disagree with some of these aspects. Well, wage growth, historical performance of equities, Fed cuts, and there's no recession. Too early to call for an end of tech outperformance. Okay. Near term, the risk of a consolidation continuing. Risk appetite has been at a 5-year high. CTA positioning 8-year high. These indicators are normalizing but still above average. However, we'd be surprised if a sell-off extended by another 5%. Right, so, okay, fine. Okay. Alright, that's a little bit from UBS. What else do we have over here? We forecast the economy to grow 1.9%. Okay, so basically zero absent AI. I'm pretty sure that's zero absent AI. Personal consumption growth is likely to weaken, but strong investment in AI and improving net trade will support GDP. Right, strong investment in AI, of course, and improving net trade. Okay, all right. Following an expected 25 BP cut in December, we forecast the Fed will cut another 50 basis points in 2026. Well, that would be quite hopeful. 50 BP more in 2026. Well, I guess that's all of 2026. So, well, but the first half, 50 in first half, could be disappointed on a hawkish meeting in December. Let's see, I can't believe it's already December. It's kind of wild. 2026 to be a year of economic rebalancing. Okay. AI investment boom is entrenched and will continue. 2026 should bring greater clarity on how productivity is affected. AI is obviously a bright spot for the economy. Less encouraging, however, is the weakening labor market. Yeah, I mean, everybody's on the same page with this. Let's see. How much is the market going to look past the hawkish cut when they know Kevin Hassett is only a couple months after that? Well, he's more than a couple months after that. He's like 5 months, 6 months after that. So you're talking half of a year, which is different from a couple of months. But then Jerome Powell retirement date, it is May 25th. I think. Term ends. Let me see here. Jerome Powell, May, governor, term end date. Pretty sure it's May 25. Because his term on the board lasts... Oh, it's May 15th. Okay, got it. So May 15th, and then FOMC schedule meetings. So it looks like the first meeting that has... Oh, is it scheduled yet? Hassett's first meeting won't actually be until June 16th. Wow. Actually, I'm sorry. June 17th. So I want you to think about that for a moment. Like, if your sentiment is, oh, don't worry, you know, Hassett's just 2 months away. Wait a second. June 17th is the first meeting after May 15th Powell last day. That's literally 7 months away. That's 7.5 months away, bro. 7.5 months away. Yikes. What the hell? Damn, bro. We got Powell for a while. Oh, man. Okay. So, Tax Foundation estimates that cumulative tax measures will boost GDP over the long run, right? Where's the labor market problem? Here, weakening labor market is the problem. Restrictive immigration policies have curtailed growth in the supply of labor, slowing jobs. Okay, tariffs, employment in manufacturing has not grown. Government efficiency to drive cuts for 8 months, diffusion, blah, blah, blah. At this stage, it's difficult to quantify the AI impact. Challenger job cuts report wasn't great. Second most cited reason for layoffs, AI-related job cuts, TBD, obviously. U.S. labor market weakening trend intact. That's not a trend that you want to be intact. Unemployment to rise further. This is not good. Soft hiring, headwinds. Despite tax cut, we forecast nominal PCE, personal consumption growth of 0.4. Household surveys suggest pessimistic about jobs levels consistent with recession. Spending by low to middle income has noticeably softened. Extrapolate them 3 to 6 months of averages. Suggests a modest rise in the national employment rate to 4.7 by the end of next year. Yet labor market is not, well, this is not yet flagging a recession. Some rule wouldn't be triggered by the above. No, you'd have to get to like 5% probably. I would argue, probably would need to rise by, yeah. You need to rise to 4.9%. 4.9%. I'd go about 5.1 to really trigger this early next year. And that's estimating where we'll be and at what velocity we'll move up. Inflation to resume downtrend. Yeah, in an interesting way, weaker jobs growth. The weaker jobs market will actually help inflation. I mean, that's a good thing to think of as well. So they think that we'll have slower growth next year, but we'll avoid a recession thanks to monetary policy easing. And the labor market helping cool inflation. All right, what is this? Into December and beyond. Clients got a bit too excited going into November. Okay. Let's see here. FOMC presser, blah, blah, blah. Clients. Consumer. AI themes. I mean, this is all we've seen some of this stuff this morning. JP Morgan a year ahead. Global equities. Greater upside in the S&P 500. Yeah, this is their 8,000 call in 2026, which they're very excited about. So look at this. As you can see here, they have a 65% chance of expansion. Now, this is a fancy chart. Would you look at this? The team sees a 35% chance of recession. It's actually decently high, honestly. You would need a pickup in hiring to temper the drag. Yeah. But this is quite interesting because they suggest sticky sluggish, losing balance, U.S. falls by itself, all fall down. 35% chance of recession. Goldilocks is really only 15%. So they only give you a 15% chance of real growth. Wow. That's wild, isn't it? Somebody writes late night with Kevin. Hey, you can also get early mornings with me, Kevin, by joining the Me Kevin membership before the Black Friday coupon code expires. Okay. Expects labor market weakness will push the unemployment rate to 4.5% next year. We expect yields to remain range-bound next year. They actually think the 10-year will retrace up to 4.25% in Q2. Interesting. Very interesting. You think that's what it is? Somebody says I have 2 microphones turned on? Is that what it sounds like? Shouldn't be what's going on, but I'll have to look into that. I wonder if maybe I can listen to it myself. Let's see what we got here. All right, let's see here. All right. Let's see here. Focus more on industry, AI exposure, and productivity. Yeah. It doesn't, I don't hear anything wild, but some of y'all say it. It's just high decibel, really? It's just loud? Is that it? Let's see here. Yeah, I just don't see that though. But I believe you. I'll probably have to go look at it later then. Yeah, quite odd. Sounds fine. Huh. Alright, well, we'll fix it later. It's quite odd. I'll take one more look here. Let me just go to audio. Audio fader. I see nothing I can do, but oh well. I'll have to deal with it later, like I say. Alright, so anyway. Alright, so US focus more on industry, exposure, and productivity. So what do we have here? Earlier this year, we evaluated whether changes in productivity across industries were aligned with AI usage, finding little correlation. Recent St. Louis Fed article highlighted another measure of AI usage, the real-time population survey. Okay. Relationship is loose, but expected that there are many variables affecting productivity. Oh, duh. Let's see here. Latest survey from Aug 25 shows 32% using Gen AI weekly for work, 13% use it every day. I feel like this is somewhat low usages. I mean, people will catch up and use this stuff more. I don't think this matters so much. I'm gonna get rid of that one. What's this one? SocGen. You just can't keep this equity bull market down. Stronger than expected. U.S. payrolls briefly start concerns that the Fed might take a pause. Let's see, relentless AI tech rise. Okay, as I told Fortune, one thing that concerns me most is that unlike 1999-2000, I struggle to see an imminent macro trigger for a bear market. Yeah, although you do have the CDS market today, that's fair. Oracle's not looking great. And the 2001 equity slump triggered only a very mild recession. When this AI bubble bursts, it will likely sweep the economy into a deep downturn. That is because the economy is now far more exposed to shifts in the equity market via AI investment directly and disproportionately boosted richer spending. But for now, the party goes on. Right. So that's actually really an interesting phrase, because what you have here is if you have somebody saying hey, everything is fine, but if it does go to crap, it'll be way worse than the .com bubble. That's kind of interesting. Dropping my headset here. All right. Cool. Recent survey signaled that what worried investors and economists was a surge in inflation. I'm not less worried about that. Okay. All right. Very good. Let's see what else we have. All right. Okay. Let's see here. Okay. Good. A few things to cover here as well. Oh, shout out, by the way, to those of you joining here. Really appreciate it. Eric, Brandon. Brandon doubled up and got both the Meet Kevin membership and Reinvest AI. Good for you. Oh, thank you for joining. Christopher, Leonard, Javier, Rodrigo doubled up as well. Got both. Black Friday deal. May as well. We got Deborah here joined as well. Jamie. Sounds like 2 girls in a row right there. Welcome aboard. Thanks for joining both the Meet Kevin membership and Reinvest AI. All right. So something else to look at. I saw this talk right here. I thought this was interesting. Somebody here is talking about something's built to last 20 years, these server racks. 200 kilowatt rack density, already future-proofs it for the next gen Rubins. And upgrading rack densities down the line won't require major capex spend due to IREN's very scalable modular infrastructure. I don't think this person realizes that probably 40% of, spend on data centers is chips, maybe even 60%. And then you got to look at, the other, let's call it 60%. If we go 40 for chips, the other 30% is probably the building and the infrastructure. And then maybe you've got 30% for racks and components and power infrastructure. So I think chips make up a very substantial portion there. Very, very big portion. Oh, it's interesting. So are you guys saying, does the audio get better or worse if I switch to sharing the screen? Somebody says, now I hear I wonder if that has to do with it. Oh, interesting. Is there like an audio issue when we switch screens, basically? Huh. Hmm. Man. Yeah, I just don't see anything changing. Screen share makes no difference. Steve started this audio mess. I know, right? Whatever. Anyway, so let's see here. IREN. If you assume Microsoft renews this cloud contract on the exact same terms, the IRR is 8%. So in 2031 and 2036, you're assuming Microsoft will still want to outsource to a neocloud. That's a big assumption. Huh. So this is somebody forecasting out to 2040. I always think this stuff is dumb, doing these cash flow statements. Yeah. And they're keeping the dollars per GPU hour stable for all these years. These are some crazy assumptions. Crazy. And does the audio get weird here, or is it better? We'll call this B audio, the Bravo audio. Does Bravo audio suck, or is it okay? All right, we'll give that a shot for a moment. And now we're back on, we'll call it Alpha audio. Back on Alpha audio right now. I don't know what the hell I screwed up. So I guess we'll find out. But anyway, I'm sure we'll find out in just a moment. Okay, so no, everybody hates that one because that one doubles. Really? That's interesting. Alpha better. Huh. Okay. Just screwed something up. That's all right. Okay. So coming off this, then we've got the Oracle article. See that. The Iron deal. Okay. Now, what does it sound like if you hear the TV? Because then maybe you could tell me, is it like Kevin's audio or just audio in general, right? Here, let's try that really quick because maybe we can fix it really quick. See if you could hear this.
I think you understand that a lot of Trump's MAGA base is not just people who are registered Republicans. A lot of them are people who are new to the system. And I think that many of those, the problem for Republicans, just like it was this past November when they lost, was that getting those people to come back out of the woodwork is part of the issue. They come out for Trump, they don't come out for anyone else. But the second thing, I do wonder if this issue of the isolationism that Marjorie Taylor Greene and maybe the Tucker Carlson espouse is part of the problem here, because Trump attracted them into the party because he kind of seemed isolationist at times. But now everybody is wondering, is that really what he is? I mean, I think some of the ideological confusion is part of the story here.
It is very hard to see how you can give $40 billion to Argentina.
We didn't give them. We did
Argentina
a currency
for their
swap, and we made a profit on it.
But you gave it 20.
And then say that Europe is a problem and they're not doing enough, and that Ukraine, everything should resolve itself very magically.
I don't think it's Marjorie Taylor Greene's fault that she thought that Trump was an isolationist.
No, actually,
I think part of the problem is that Trump's vision for politics is whatever Trump wants.
No,
and
all right. Anyway, yeah. All right. Interesting. Yeah, because I was changing some things earlier, so I wonder if something a lot of reverb. Really? That's weird. I wonder if something accidentally got bumped or whatever. But oh wait, I wonder. What if I do that? Can you hear? Is that better? I don't know if that made any difference. But let me know if that's any better. So we'll see if that's that did anything. All right, so we'll see. What else? All right, so did y'all see that thing on the Robovin? I'll talk about that in just a moment, too. Okay, so that was this. This was an interesting piece. And this was sort of Ashok here mentioning being on it in terms of full self-driving for like FSD for RVs. And I thought this was very interesting. So that's, yeah, I mean, this would be so incredible if they could actually come out with a better vehicle or a new vehicle, just something else. But very interesting. I don't know what this means though on it. It might not be anything, right? Okay, good. So now what? Let's go to, let's see the times, what the times have here. Okie dokie, what do we have here? Tesla RV, yeah. U.S. pauses all asylum. U.S. pauses all asylum applications and halts visa apps for Afghans. Oh, now people are saying it's echoing. Guys, I don't know what the hell is wrong, so I might just, like, go record my video alone, because there's so much to talk about, but this is just a pain in the ass. Like, I can't concentrate when all I hear is people bitching. And in fairness, if all you hear is echo, that would be annoying too, so I get it. But I don't know what to do. So, see, and then what happens is, like, I do nothing, and then people are like, oh no, you're fine now. So, like, I don't know, I also don't know what phase of the video people are in, you know? So it's just so exhausting, because there's like a 30-second lag sometimes, or sometimes people are 10 minutes behind on the video. I don't know where you are, you know? I haven't changed anything in, like, the last, you know, since I said I changed something, which was like 3 minutes ago. So, well, anyway, what is this? Okay, Trump pauses all asylum applications and halts visas for Afghans. So what is this? Okay. Some people say there's a reverb. I don't understand how. How is there a reverb? It makes no sense. Reverb. And see, I don't hear that. Well, and I'm monitoring it. But apparently it's different for some people here. And the TV doesn't do that?
Is the person who just said to me that it is comparable to say that Nick Fuentes, who is literally a neo-Nazi, is the same as somebody, a liberal, who has an opinion, who is not a neo-Nazi. They are not
a hateful opinion.
The same.
How do you want? Excuse me. Just let's go back to this point one more time.
But
Nick Fuentes can espouse an opinion on Tucker Carlson's show.
It is not the same.
And he didn't push back the same way you didn't push back when someone called someone in my family.
Hold on a second.
It's not different.
Hold on a second.
Test. Hello. Hi.
He did, they would never, first of all, I would never invite them on the show, and they would never be invited back. So those two things are
but yet
not
you've gone on Jennifer
the
Wilson's
same
podcast. It's the same thing.
They are not the same thing.
What I think
okay?
But
Katie, but hold on, Katie.
No,
do you believe that Jennifer Welch has a right to say something negative about your husband?
The same way Nick Fuentes has the right to say what he wants to say. So
you think that it's okay? Hold on. Do you think it is okay for Jennifer Welch? Is she allowed to say something negative about your husband?
Absolutely, and it's your job as a moderator to push back.
So that's the first thing.
It's the same way.
Okay. How's that? Is that better? No echoey? I don't know, I'm just guessing at this point. Pan. Alright. Anyway, where were we? So, let's see here. Let's go to here. Somebody says better still echo. So the TV echoes too? Because if the TV echoes as well... Oh. That would be very interesting. If that's the case. Huh. So a lot of people are saying no. What if I just... Okay. How about that? Let's kill that. Kill that. There. I don't know if that'll solve it, but I'm just going through killing stuff. I wonder if that'll be better. Alright, I just made like 27 different changes. So, you know what they say in scientific experiments, you should always change 27 variables at a time, so that way you could isolate what the problem is. Yes. Alright, so... Alright. Cool. Is everybody happy now? Really? Alright, changed 27 things and y'all like it now. You clicked and it fixed. Alright. Very well. I know what to test tomorrow. All right. Right. Okay. Well, wait. Does that mean... No, Kevin. Don't change anything. Don't change anything. Let's go through all this news and just go enjoy Black Friday, okay? I got a lot of things to cover that I've already kind of researched and put together. So we're going to put together a lot of different things here. We'll just sort of hit these in order because there's quite a lot. Right. All right. Let's do it. Jerome Powell is talking on Monday, but it's not what you think. And we've got leaked audio with Witkoff and the Russians, which is a little embarrassing. Airbus might end up having an oopsie-doopsies that could lead to a lot of flights getting grounded. We've got calls for a potential 35% chance of recession at JP Morgan and only a 15% chance of real growth in this economy. A lot of things to break down, and so today, being Black Friday, let's just start by reminding you to go to meetkevin.com, get your Meet Kevin Alpha report for the Black Friday sale, and make sure to get your Reinvest AI over at househack.com or reinvest.co as well. With that out of the way, let's get started. Keep in mind, we will be raising the price massively this weekend on those, so make sure you get in before that price increase. If you see that Black Friday coupon code is active, you are good and golden, and you are getting the best price guaranteed. Okay, so why don't we go ahead and start with these leaked transcripts before we get into the recession and markets. I want to talk a little bit about Putin and what's going on with Ukraine. So apparently Witkoff got on the phone with Yuri, the foreign minister of political affairs in Russia, and the transcript is kind of bizarre, honestly. So this is the transcript right here, and I highlighted the most interesting components of it. This transcript is from Bloomberg. It's likely a leaked transcript that came from inside of Congress, because the recording of the call did end up getting into the hands of committees within Congress. So that's likely where the transcript of the call leaked from. And what I find that's very fascinating here is you could hear Steve Witkoff get on the phone with Yuri here in this transcript. Steve Witkoff says, well, listen, I'm going to tell you something. I think if we can get the Russia-Ukraine thing solved, everybody will be jumping for joy. Yuri, you actually see a lot of doubt here. This call, by the way, took place on October 14th, about 6 weeks ago. But it's really important because it sets this groundwork for this quote-unquote 28-point peace plan that supposedly is being negotiated between Trump and the Russians. Meanwhile, Putin comes out just yesterday and he's like, I don't know anything about this plan. This is nowhere close to final plan. I can't do a great Putin accent, but the point is, you can actually see the eagerness of the Americans here, Steve Witkoff specifically, trying to make a deal. And in my opinion, it comes across as somewhat childish how eager the United States is to get a deal. Of course, Trump and the Trump administration are defending it, saying that this is just negotiating. But let's just stick to the facts and let you be a decider of what you think about this. So take a look at this. My friend, I just want your advice. Do you think it will be useful if our bosses talk on the phone? Steve says, yes, I do. Okay, so keep in mind, Yuri, his goal is to get Putin and Trump on the phone because Putin's really good at talking. And Putin tends to manipulate Trump to delay. That's what's happened every single time there's been a discussion. Anytime things get hard, Putin wants to get on the phone with Trump, and then all of a sudden, magically, Putin gets a whole bunch more time. You know, they start with this joke of Yuri saying, happy to help you solve this problem to make sure everybody gets their joy and is jumping up and down. You only need to solve one problem, and that's the Russia-Ukrainian war. And of course, Witkoff says, how do we get that solved? Yuri goes, hey, maybe we could get Putin and Trump on the phone. Trump's ready to do it. Okay, Yuri's like, great, awesome. And Yuri's kind of like sounding like he wants to end the phone call here. It's like, great, yep, let's get Trump and Putin on the phone and be done. But then Steve Witkoff, he talks like 27 times as much as Yuri does. And listen to his phraseology. I would make the call, this is Putin to Trump, and just reiterate that you congratulate the president on this achievement, that you supported it. You supported it and that you respect he is a man of peace, and you're really glad to see it happen. And I would just say that I think it's going to be a really good call, because let me tell you what I told the president. I told the president, the Russian Federation, have always wanted peace, and that's my belief. I told the president that I believe that, and I believe the issue is, we have two nations that are having a hard time coming together with a compromise. I am even thinking that maybe we set out like a 20-point peace proposal, just like we did in Gaza, put a plan together, and my point is this. And then Yuri interrupts. Okay, my friend. I think the point is very clear. Our leaders could discuss. Hey, Steve, I agree with you, okay? We will suck him. We will suck him off. Okay, he didn't say it. We will congratulate. We will say that Mr. Trump is man of peace and so. And he will say. But Steve goes, but here's the thing that I think would be amazing. Yuri, okay. And you can kind of tell, like, Yuri's just like, bro, just get him on the phone. I don't want to play this game. Like, I'm done with this call. And Steve's like, no, man, I got to ShamWow sell you, bro. I'm selling you on this deal. You gotta suck up to Trump. You got to talk about how brilliant Trump is. Like, Steve's basically trying to lay out this whole plan. And then you're, okay. What if, hear me out. Okay, I will discuss with my boss and I come back to you, okay? No, hear me out. And then he wants to keep going, right? And Steve Witkoff goes, because listen to what I'm saying. I just want you to say, maybe just to say this to President Putin, because I know, I have the deepest respect for President Putin. That's interesting coming from Steve Witkoff, but he gets into this. Maybe he says to President Trump, Steve and Yuri discussed something very similar to the 20-point peace plan that could be something that could move the needle a little bit, and we're open to some sorts of things. Maybe we could do a land swap like Donetsk and maybe a land swap somewhere else. And instead of talking like that, let's talk more hopefully so we can get a peace done. Steve Witkoff is basically like, can you pump up Trump and make it seem like he has hope? And then we could like pitch that we have some kind of 28-point peace plan and we could get all this cheer and enthusiasm that, we're the stewards of world peace. Okay, sounds good. And here's one more thing. Zelensky is coming to the White House right now. I know that. I will go to that meeting because they want me there. But I think if possible, we will have the call with Putin before the meeting. Before? Yeah? Correct. Okay, I got your advice. I discussed that with my boss and come back to you. Okay, Yuri, speak to you soon. Great. Thank you so much. Thanks you. Bye. Anyway, so like this whole call really comes across as Witkoff like getting on his knees going, please, just get Putin on the phone. Tell Trump how great he is and how there's potential for a 28-point peace plan or whatever. And really the idea there, in my opinion, is they're just trying to prop up that there's hope. Like this is how Trump negotiates, okay? If I can come across as making it seem like the Russians are on board with the 28-point peace plan, then I could go to Zelensky and go, the Russians are on board with the peace plan. You should accept the peace plan. And if Zelensky accepts it, then they can take that acceptance and go back to Putin and go, I got him to accept it. And then Putin go, okay, one more change, right? But the reality is, like, Trump and Witkoff are scrambling to get this 28-point peace plan. They're going to the Russians, and the Russians are like, we don't want anything to do with this. Zelensky's like, bro, this isn't even close. And you don't really have anything. So it's an interest, like this dialogue right here, this transcript, I think really says we ain't going nowhere anytime soon with this Russia-Ukraine peace deal. Now, of course, there's no denying that there's been corruption in Ukraine, and I know the probe of, the de facto VP who just resigned in Ukraine doesn't look good, but it's also a sign that they are chasing corruption in Ukraine. And we also don't know if Andrei Yermak was corrupt. he got raided, but a lot of people are treating him as guilty until, well, basically proven otherwise, including David Sachs, who's in the White House as the crypto czar. Sachs is basically cheering, I told you all the Ukrainians were corrupt 2 years ago, and I was right, because a probe is happening. It is kind of interesting, but that's the sort of cheering that's going on ahead of actual conclusions coming out. And I always like to be cautious of things like that because I think sometimes you could really put the cart before the horse and cheer about having a deal when you don't have a deal at all. So that's a little bit on Ukraine. On top of that, another piece that got a lot of attention today was the Washington Post piece that Hegseth ordered a strike on this was one of the first strikes on a one of these drug ships in the Caribbean. And the ship apparently was targeted by SEAL Team 6, and they struck the ship, and 9 people appeared to die immediately. And Pete Hegseth gave an order and said that, quote, the order was to kill everybody. And so after the smoke cleared, this drug ferrying boat was then struck a second time because they saw 2 survivors that were holding on to the shipwreck, basically, and then they bombed the 2 survivors as well. And so this has been a big messaging play by Donald Trump that, hey, if you smuggle drugs in the Caribbean, we're going to blow you out of the water. And Donald Trump is cheering this obviously as a large success that, wow, there are all of a sudden very few boats in the Caribbean. Makes sense because he's trying to send this deterrent signal. Makes a lot of sense. So then we've got Skyling says, I just got both programs. Yeah, if you have any questions, by the way, on the programs, just a quick reminder because I know it's confusing. If you have any questions, first of all, you could always email us. staff@meetkevin.com. But there are really 3 things, right? There's Meet Kevin. That's the Alpha Report membership at meetkevin.com. The courses, trade alerts, top 10 stocks, whatever, right? That's one thing. Then there's the Reinvest AI. That's another thing. Those are on Black Friday sale. And then, of course, you can actually invest in the AI real estate startup Reinvest, also known as House Hack. At reinvest.com, right? So I always like to segment that, but I see you asking here, and I wanted to help you quickly. All right, so Melania Trump is also apparently now announcing that she's going to get into the business of making movies, and she's announced the formation of Muse Films. Muse Films is now being created by Melania Trump. On top of that, I also briefly watched part of this Cardone and Saylor interview. I had to click around because I was really having trouble listening to what I've heard Michael Saylor say about 20,000 times before. And I even listened to Cardone and Eric Trump just sort of go on about Bitcoin. And a lot of these arguments we've heard before. But I think one of the most interesting things for me is that Cardone argues that now, at least his latest funds, or what he's arguing now, is that he's 1/3 debt, 1/3 Bitcoin, and 1/3 real estate. And I think that's very interesting because if you end up in a volatile market or any kind of recession, you've really destroyed all of your downside protection. Because, in an extreme example where, Bitcoin, which has happened, is down 70% and his real estate's down 10, 20% or something like that, your debt ratios are going to be so far out of whack that you might end up being not only negative cash flow on your real estate assets, but because you have now debt that's actually based in part on Bitcoin as an asset, which seems odd unless you're talking about appreciated real estate. But then it's, obviously not clearly leveraged to what it could be, which would be a good thing. But I guess what I'm trying to say is if you have 1/3 debt, 1/3 Bitcoin, and 1/3 real estate, and Bitcoin goes through a normal kind of 70% correction cycle, let's just math it out really quickly to see what your debt ratios would look like and what your real estate positioning would look like relative to that debt. And I don't think it's good. So let's do it together so you can kind of transparently see what that would look like. So if I go into a quick spreadsheet and just throw in, let's do $100 of, we'll call it crypto, we'll go loans, and then we'll go real estate. And we'll go 100 on each of these, right? Those are net assets, obviously, of 300. Now, if we had a correction cycle and this was worth 30 for a moment, and let's say this was worth 80, well, now you've got 110 of assets. Sorry, you have 200 of actual assets here, right? So 200 of assets, 100 of loan, I should say. Let me clear that up a little bit. So in this case, you have a 50% debt ratio. But in the example over here, where, if all of a sudden crypto goes through a down cycle and your real estate goes down a little bit because you've mostly bought in Sunbelt, Southeast, like Texas and Florida, where you're overbuilding and the real estate market is much more sensitive to these swings. Now, all of a sudden, you're at a debt ratio of almost 1-to-1. You have 110 million in assets versus $100 million of debt. I think what you've really done is you've increased your risk profile, not decreased your risk profile. I think Cardone is trying to suggest he's actually de-risking by exposing to Bitcoin. But what he's actually done is he's introduced a massive volatility to a real estate play, probably to try to attract investors, because I wouldn't be surprised if he's slowing down on people investing in Cardone Capital, because people are starting to wake up and realize Cardone's trying to take a 35% waterfall and a asset under management fee every single year and an acquisition fee for acquiring and holding Bitcoin and real estate. It seems odd to me. And I'll obviously read his documents, get his exact numbers. This is just roughly what I'm gathering from briefly watching this interview. And I think it's wild because I think what he's done is he's exposed himself to being in a really nasty debt position by having an asset that is really aligned with the risk markets, which are at all-time highs. The stock market is very aligned with crypto, and real estate is usually on a different cycle. Real estate goes through booms and busts as well, but usually years separated from a stock market boom or bust. Very, very normal. So usually what you find, savvy investors will look for a stock market that's at all-time highs, and they invest in real estate. And then when real estate's at all-time highs, like the Airbnb bubbles or whatever, they take money out of there and they get into the stock market, which is often at lower levels. We had this huge Airbnb boom. Everybody wanted to get into Airbnbs in late 2021. It really fueled this boom throughout 2022. Well, the stock market was at lows in 22, but you still had a booming real estate market because people were still getting low interest rates in the 3% range. That flipped, obviously, 24, 25, where, the stock market is higher and real estate market's much more stagnant. So I was somewhat surprised that Bitcoin or Cardone is exposing himself to that kind of stuff, but I guess he is. So that covers Ukraine, a little bit on Hegseth, a little bit on Saylor and Bitcoin and Cardone. We've still got to talk what's going on with Airbus and what's going on with Jerome Powell. So let's get Airbus out of the way. And then we got to talk Tesla as well, because that'll be quite fun. So if you haven't seen it yet, there basically is this massive Airbus software problem that needs to be fixed. And it all goes back to an issue that actually happened on a flight in October, where quote unquote 15 people were sent to a hospital after a JetBlue flight drops in altitude, forcing emergency landing. This is like a really scary, crazy headline. But what you have to realize is when you actually look at this, the article says that 2 children and 12 adults were taken to the hospital with, quote, minor injuries. So we had minor injuries, which is often an indicator that, people almost just went to the hospital for liability's sake, or just in case, people bump their heads or whatever. Like, well, check you out just to be sure. The airlines do that because they want to encourage you to go to the hospital to sort of wipe that liability. We didn't discourage you from going to the hospital, right? I'm not saying that these people didn't belong in the hospital, but I have a feeling these people didn't belong in the hospital. Why do I say that? Because here you could see that in the actual data, as Scott pointed out here, in the actual data, the aircraft, the A320, fell 100 feet because of a flight control issue. And then the pilots pulled it out of that dive, that 100 feet, mind you, dive, at 1.4 Gs. Okay, so let's just understand this for a moment. 1.4 Gs It's not comfortable. You're going to feel it as a passenger. It's an adjustment, but it's probably the extent of you like bonking your head on the back, like suddenly like, whoa, what happened there, right? 1.4 Gs, relatively minor. You get to 2 Gs pretty quickly, doing some steep turns. Very common in flight training. And the descent of 100 feet is also by no means a dive. A 100-foot difference in your altitude at 35,000 feet, most of the time you don't even notice it. It happens so modestly and so quickly. But obviously, the pilots noticed this deviation in flight control is likely starting to tilt down, and they took over and presumably overcorrected. I think the pilots did the right thing to land immediately, and this is nothing to say the pilots did anything wrong, but an autopilot descent versus a pilot, oh my gosh, what's happening, the reaction is going to be a little jerkier. So my opinion here is what happened with that 100-foot drop, not a big deal. What matters more is why it happened. And that's actually the scarier part. So apparently what happened was you had a flight control failure because of some form of software bug in the A320 that may have been caused by solar flares. And this is because the A320s are a fly-by-wire system. We had this in the Phenom 300. Basically what that means is if I push the throttle forward, my throttle lever isn't actually attached to some kind of lever that attaches to like the gas valve opening to these turbine jet engines. Instead, I'm just sending a computer signal. That's all the throttle is doing. Like, I may as well just be turning a little knob, or like may as well type into my computer, set throttle to 99%. It would do exactly the same thing as pushing this fancy lever forward. The point of that is, when you have a system like that, it's a lot harder to fly if you have software bugs. Because if you have a software bug, like if I have a mechanical plane that's not fly-by-wire, like it's actually attached, and I could fly the plane like any kind of older plane, or, I mean, the Phenom 300, as an example, the jet that I flew has, I could steer, and I have direct steering. So, when I move my yoke, the ailerons of this aircraft move, right? When I step on the rudders, it moves. But that throttle control column is all by wire. It's all computers. And so what happens is if you get solar flares that somehow create some kind of bite flip or whatever, and you get a software bug, you got to now uncorrupt this data to make sure these aircraft can stay afloat. It's actually kind of scary because, we should be grateful we saw that JetBlue flight only drop 100 feet, because what if they weren't able to regain control? Now, obviously, there are many redundancies, and I'm grateful that they're announcing that these aircraft are getting this software update. It's a pain in the butt because there are about 6,000 planes, and it takes time for somebody to go around. You probably have to budget like an hour per plane, or maybe even more, for somebody to go around and update the software for all these aircraft. So the aircraft has to be taken out of service. Somebody has to be available to do the software upgrade. These aren't like Tesla over-the-air updates. The software updates, especially on older aircraft, they're a pain in the butt. They usually involve manual memory exchanges into the systems and multiple restarts and verifications. They're a pain in the butt. If there's one thing I hated about the Phenom 300, software updates, most PETA ever. Like, mechanics charge you $750 just to do a software update. I kid you not. $750 to do a software update. Like a free software update. Like, the software doesn't cost you anything to update. Well, $750 to do it because it's such PETA. It's wild. So now imagine this on a global fleet of 6,000 of these aircraft. Yeah, you could see quite a lot of downtime over time. Now, a lot of airlines so far, some airlines have actually paused bookings on some of these aircraft. Otherwise, a lot of them are scheduling to get these issues fixed. But it's good because the FAA has put out an airworthiness directive on this, an emergency order essentially demanding that this update go into place, and it's good. That's exactly what they should do. It's an emergency order that, basically don't fly the planes until you upgrade the software to fix this solar flare bug. It's a really big deal, especially on these aircraft that are so electronically sensitive. The software can't have bugs. So grateful to see that they're working on solving that. Now, with that, I want to touch on Tesla, and then let's talk about Jerome Powell and markets a bit. So Tesla had a nice little sort of viral thread this weekend. It wasn't very long, but Gary Tan basically said, hey, can we get FSD for RVs? And that's really because somebody was showing a video of them driving an RV and how cool it is or whatever, but how nice it would be to have full self-driving. And Ashok then responds from Tesla and says on it with a picture of the Robovan, which stands for Robo-Van. Now, the Robo-Van, mind you, I kind of think was a little bit of, like, I don't want to say it, but it was a little bit of a scam, mostly because this is my opinion, okay? I think it was just a remote-controlled concept that they wanted to show off on their Robo Day. And that's fine. Like, I get it. This thing reminds me of iRobot so much. I love it. Like, it's really cool. I want this. Obviously, you don't have windows in the front. It's really trying to send this signal of, hey, we can have a fully autonomous vehicle that can actually house a lot of people, right? Like, you basically have a bus or an RV or whatever that drives itself. And I thought this was really cool. I'm 99% convinced it was just teleoperated. Which makes sense. But the vehicle would be so cool, and I love that they're saying on it, because as somebody who owns the Cybertruck, the Model X, and the Model S, I would love nothing, and I've had the original Tesla Roadster, I would love nothing more than FSD 14.2 or greater on a Mercedes Sprinter-style van or a Robo-van, whatever you want to call it. I will buy it. I will be the first person to order it and buy it. Just make me a new car. Just give me another product I could buy, Elon, so I could buy it. So juiced on autopilot. I was at the doctor the other day. They're like, oh, we saw you driving the Cybertruck. How do you like it? I'm like, love it. FSD is great. I don't want to drive a car without it. Sometimes I have to, like the Sprinter van, but it's just a great, great product. I think the only thing that really gives it a run for its money and greatness is the Reinvest AI. Okay, honestly, I have to say, I was going through our test flight on it earlier, and I was like, oh my gosh, this is so cool. I can put in a zip code anywhere across the United States and go, show me the deals I should prioritize. And it's actually showing me really good deals. And I'm like, we're about to democratize real estate with artificial intelligence in a way nobody's ever done before. And I'm so excited for it. And so obviously you could get, just sort of as subscribers on YouTube for now, because I'm marketing this myself, right? You could get lifetime access to our AI on the reinvest.co website. I imagine, if venture capital got a hold of us one day, because you can invest in the company as well. Read the solicitation. This video is not a solicitation. I imagine if venture capital got a hold of us one day, they would be really mad that I offered people lifetime access, but I'm never going to rug my subscribers and my supporters of the channel. So anyway, check it out. Go to reinvest.co. I think it's really cool. You can see our AI section. That's on has a Black Friday sale. And then you could check out, of course, if you want to invest in the company, read the offering circular and disclosures. There's risk with every investment. But you could read about that. Get, I feel like we're valued as a real estate startup. At a pretty low valuation, $1.40 a share is the conversion price. And I think, if this AI keeps going the way it is, we're already ROI positive on our investments into artificial intelligence, just with the sales we've done so far. It's really incredible. Then I think the future is really bright for the company. Knock on wood. But anyway, let's now talk about markets. And Jerome Powell. So Jerome Powell is expected to speak on Monday. And a lot of people are wondering if this is going to be some kind of rug pull. So Fed Chair Jerome Powell delivers brief remarks and participates in a panel discussion on George Shultz and his economic policy contribution. Event takes place during Fed blackout, precluding remarks on economic outlook or monetary policy at Stanford University. And there will be a moderator doing a Q&A. Now, I think this is actually really interesting because what this signals to me is, nothing. No, a lot of people are going to say, wow, this is actually really weird. Why is Jerome Powell going to an event during the Fed blackout period? And it might come across as quite odd because it is. Like, usually you don't see these events happen during the Fed blackout periods, just 9 days before a rate cut meeting. But I will imagine that the moderator will be pretty guarded in terms of allowing any kind of questions to get through the Jay Powell that could put him in an uncomfortable position. And I think Jay Powell will be pretty good at dodging any kind of economic or monetary policy questions. But really it is strange for them to do a Q&A event like this during a blackout. George Shultz was, back in the 70s, a Treasury Secretary, Secretary of State, Secretary of Labor. He's got a big legacy of public service. Powell will probably talk up his integrity and his effort in opposing Nixon price controls, which have a little bit of a comparison to tariffs today, and a pushing for basically free markets and free trade. Like, there could be some talk on that. But broadly, I don't think we'll get any real clues there on rate cuts. What's really more likely to happen, in my opinion, is we're going to get a hawkish cut, and we'll get our cut in December, but it will be hawkish. And that's what brings up this JP Morgan scenario, that not only do we have this potential 35% chance of a recession, where either the U.S. falls by itself with a 20% downturn chance, or all countries fall with a 15% chance, but that they only actually give us a Goldilocks chance of 15% for real growth, and that we might be stuck in sticky or sluggish growth, or a losing balance scenario. 50% chance of sluggish or losing balance with, crappy labor. And then, of course, a combined 35% chance of recession, only 15% chance of real growth. And this comes in the same piece where JP Morgan actually does have a bullish price target of the S&P 500 hitting 8,000 by 2026. But it's very interesting that in the same exact piece where they say, yeah, S&P 500 could hit 8,000, and that's what's getting all the headlines, in the same damn piece, they say we really only have a 15% chance of real growth and a 35% chance of recession. Not great. Which sort of delves into what we're seeing at Morgan Stanley and some others. Like, for example, if I look at Morgan Stanley's piece, they've got some interesting notes here. So Morgan Stanley, they're looking at the consumer, and what they think is that the consumer is basically going to be weak through about March and April. You can see that in the charts right here on the right. Goods versus services spending. They actually think we're going to be at a hole in the fourth quarter and in Q1, mostly because of tariff pull forward and taxes, blah, 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 whatever. And they think that for now, it's great that rich households keep spending, but it's going to take time for the lower part of that K-shaped recovery to get a boost. And that's going to come from lower rates on credit cards and cars, as well as lower inflation. But it's not going to come until the second half of next year. So expect a consumer discretionary recovery second half of next year. And in the meantime, you got to get through the labor market problems. So tax refunds probably won't show up until March or April. I would guess that we could stick a soft landing if we can make it to May, like April, May, with good employment data. But keep in mind, somebody on my live stream was like, oh, but Kevin Hassett's coming. Bro, Kevin Hassett ain't coming for another 7.5 months. Like, think about that. Kevin Hassett won't actually have a Fed meeting to attend until June 17th. Because Powell's term ends May 15th. There's no Fed meeting in May. And so June 17th would be the first meeting that Kevin Hassett could attend to. That is 7.5 months away. That's not good. So you got quite a while to wait to get to Kevin Hassett. You got a lot of unemployment problems to get to until then. And hopefully we've had good Black Friday data. I mean, I know that our Black Friday stuff has been doing great, but I also know that people investing in, the Meet Kevin membership or in the Reinvest AI or even in Reinvest the company itself, these are investors. These are people investing in their wealth. These are people wanting to make money. These are, you listening to this video, you're not like that dime a dozen person who, wants to hear far left crap or far right crap. Like, I feel like you're a reasonable and rational person, mostly in the middle, You know, you might be 20, 30% to one direction. That's okay. It's okay to have, a side. But I think that you're looking for a true understanding of what's going on in the economy and what's happening. And based on that, really the consumer spending that we're seeing outside of like these sort of investment style products, Bloomberg is suggesting it's Gen Z kind of stuff. Teenage brands are winning because they're pitching better deals. Like Bed Bath & Beyond, Brandy Melville, I don't even know what the hell that is, Kendra Scott stuff, Etika, whatever. Like they're basically saying it's these teeny bopper brands that are doing well, but otherwise Black Friday has been pretty crappy, is so far one of the initial assessments of what's going on with consumer spending. Now, consumer sentiment has already told us as much, that consumer sentiment is total trash right now, not great. But really what we should look at is the labor market. And the risk is that we normalize on the Beveridge curve. We already know about this. We normalize over here because of more layoffs, we have a problem. Now, there is an upshot. And the upshot would be that we actually end up seeing a pickup in labor force participation in 2026. So basically, let me rephrase that. They're saying we have seen an uptick in youth labor force participation. And if we go back to a normalization next year, participation doesn't expand as much, which means the unemployment rate stays more stable. Okay, so they actually think the participation rate will decline in 2026 and 27. The thing that could really lead to a surge of participation would be the stock market falling, and then a bunch of people rush back into working, and that'll shoot the labor market, way high in unemployment, and then you have your recession. But here, Morgan Stanley is arguing they only see a 4.7% unemployment rate going into 2026. And this roughly aligns with what you're seeing with some of these other outlooks, which we're going to look at in just a moment. A more bearish point of view is right here from U.S. Macro Strategy from MUFG. And they argue that recoveries in markets happen very slowly, but deteriorations happen very rapidly. And they say that we see a risk of a more rapid decline in the months ahead as firms stop hoarding labor. And so this really puts us through what I'm kind of going to start calling like a labor lull, where you're probably going through this decline right here, and then you might have even more of a labor hole, and this is what we're going through. And we're hoping that this labor hole of Q4 is just temporary or transitory, and that we actually get back to growth next year. That would be the best case scenario. But the problem is, they see here that firms might stop hoarding labor if Black Friday sales and Q4 sales are bad. Or January sales are bad, people are like, that's it, we can't hold you anymore, you're out of here. And then you get this surge of layoffs in February and January, which then of course drops spending. And then what do you have then? Well, then you're in a recession. So we'll see. Hopefully not, obviously. Now, Morgan Stanley also takes a peek at investment themes. Obviously, artificial intelligence being one of the most desirable here. Something when it comes to the market here is that so far it looks like earnings remain resilient. You're getting revisions written up on earnings expectations, which is good. They're bullish on things like Gap and Macy's and Urban Outfitters. I think they might be a little early on that, although we have seen some consumer discretionaries come back, like Dave & Buster's over the last 4 or 5 days. Another one like Six Flags has come back a little bit. Target's come back a little bit over the last 5 days. But of course, they think that AI CapEx is really only going to be constrained by debt, which is exactly how I feel. Debt is the only thing that's going to hold back this artificial intelligence spend that is otherwise booming. They think agentic shoppers are coming, and that's going to be good for Amazon, Walmart, and Wayfair, but maybe bad for companies like Etsy or Figs. My opinion pins on that. And then, of course, they argue here that, there's a lot of fear about a Gen AI investment bubble, but a lot of folks are looking for, okay, well, can we at least get real revenue? And this is where I'm throwing us, at least, I'm not trying to say we're like a Palantir or Meta or Google or Microsoft at all. I put us up here because we are seeing positive returns already on our artificial intelligence. So, we've invested in Blackwell chips, we've invested in AI infrastructure, and what we're finding is that just with the product we're selling so far on AI, we already have a positive ROI on every dime that we have spent on artificial intelligence at HouseHack and chip investments and developers and software development or whatever. We have a positive ROI on that already. And that's really incredible. And I mean, I get it, because I look at the product myself, and as somebody who's done real estate for 15 years, I look at this and I'm like, oh my gosh, I could put any zip code in the country in here, and I could prioritize what deals to look at. Like, this is sick. I could sort them by, most recent listings. I could sort them by potential value, like what rating they're given. This is great. And there are even more features obviously coming out in 2026. So we're really excited about it. And we think people share that enthusiasm with us. And so if companies can do that, if a company like Palantir can prove to corporations, hey, if you invest $1,000 in us, we'll get you a $100,000 return. Why would people not throw more $1,000s at it, right? I think that's what Palantir's seeing. I think that's what Meta's seeing and Google's seeing and Microsoft's seeing. Now, of course, is it going to turn at some point? Sure. Like, at some point, there just won't be any more debt to finance. And this is why we want to expand without debt. And we are. But this is very interesting to me. This, not this one. This cost of debt right here. This AI CapEx might also be relatively price insensitive. And so, in other words, companies are like, hey, if we have to pay a higher interest rate, we will, but we want to attract that capital to invest into AI. So the boom kind of keeps going, which is interesting because it kind of gives you this weird duality. Like, how on one hand is there a 35% chance of recession, but on the other hand, people are going to keep booming money into artificial intelligence. And I think the only way to reconcile that is with this ANZ research piece, where you basically say, look, AI is the economy right now, right? We can't deny that AI investments are a bright spot for the economy. No way you can deny that. We expect a 25 basis point cut. But here's the thing. The weak labor market could ruin everything. So, like, the way I look at it is, if we have this pendulum, okay, this is like the pendulum over here, and it's swinging, okay? And this right here is the recession. I should really put that on the left side. That'll be the left tail. If that's recession and that's Goldilocks, and we're kind of just swinging back and forth, what pushes us to recession is only labor, right? And you could actually have a labor-led recession and AI investment booms. It's just you're not going to see that AI investment boom in the stock prices anymore. So you'll still see the AI investment boom go on for a while. So I think Burry's like years early on this depreciation curve issue. But I find this a somewhat interesting analysis, especially since, I mean, at least right now, we're not seeing a risk of recession yet, as ANC says. But as we hear from other companies, hey, 35% chance next year for a recession. And when you look at what, where is it? Where are they? I lost them. I already closed them. What the bears say, the MUFG group, when you look at their macro outlook, it's kind of like, well, remember, deteriorations happen suddenly. And so this is where I'm of this middle mindset where I say, like, this is not a question of to invest or not. Like, definitely invest. But do you want to invest in a place where if you get rug pulled because some deterioration happens all of a sudden and you weren't prepared for it, that you go bankrupt and you start over? Or do you want to invest in a way where if the market goes down, it doesn't matter, you could actually buy more? I like the latter. I think that's great because you don't want to be exposed to a poopsie doopsies. So that then leaves the December Fed meeting. And the December Fed meeting, unfortunately, is one that I think will be a negative catalyst. It'll be hawkish. And because I think they're going to be hawkish, you're going to end up having more sensitivity to data in December. So I get bearish after really December 9th. So we'll see. Now, some people are already hedging this, like what you're finding with Oracle's credit protection. Credit default swaps at Oracle are now almost as high. Wait, let's see here. The price of a 5-year credit default swap is at risk of toppling a record set in 2008 on borrowing, which is crazy because that's scary, right? Like, we don't want to be in that kind of place. Oracle CDS has hit a record 1.9 percentage points in 2008. And, right now we're sitting at about 120, 130. So we're trending back to what we saw in 2008. This could just be hedging, or it's an early warning sign. That's also why people are looking at gold and silver going, okay, people are running to the precious metals and away from risk assets because they're nervous. Might explain also why Palantir stock has had its worst month in 2 years during the AI sell-off, and that was published today. So, like, even today, it couldn't really come back to that growth level. So, we'll see. At the same time, you still have venture capital funds that are quote-unquote snapping up zombies, like brands like Evernote and Meetup and Vimeo. They're buying these companies, cutting the staff, and then they're trying to milk them for what they're worth by raising prices. Kind of wild. But this puts together, I think, a very consolidated view overall of what's going on out there. Now, I'll take just one last moment here just to mention this Reinvest course is part of the Meet Kevin membership. It's going to have brand new lectures and some really good quality stuff you're not going to want to miss. This whole course is going to drop all the other ones are already out, but the new course will drop on December 1st. So if you want to be in, get that new content, it will come out on December 1st, which I'm very excited about. And then in addition to that, you are looking at reinvest.co has its Black Friday sale as well. So take a look at that. Lifetime access to the AI, reinvest.co. If you get that, you could bundle up the Meet Kevin membership, get lifetime access to the Meet Kevin membership over there, which comes with all the courses, lifetime access to those. That's why you get the new courses as well, so existing members will benefit from that as well. The top 10 stocks to buy for the next 10 years, not personalized advice, obviously. And then if you want to invest in house hack, obviously make sure to read the offering circular and read the risk factors. So there you go.